Welcome everybody once again to Developing Strategies, our webinar series in cooperation with the broker Argus FX. My name is Stefan Friedrichowski, and today we have the 1st of September, 11 o'clock as usual, for the English webinar. Okay, today we have three topics. As always, we have questions and answers from last week because, as in this case, I have to mention there was one mail. There were several mails, but this one has had a lot of very good and deep leading questions. So questions I simply would like to share with you and to mention those answers as well, because it's worth to do that. I call those questions really high content, high value questions, and I want to go briefly to my answers and say a little bit more as promised to the one who raised those questions, but they are extremely helpful and very good. One question was related to risk and money management, and I will go into that topic a little bit more in detail, just to show what I personally do with risk and money management. There are only two basic rules, and that's all. So, but let's see for that, although it was one of those questions. And then there has been a couple of other questions concerning the class trading strategy. Yeah, so to say, a little bit more question marks. How does it work, and where is it leading, and yeah, and so on. Therefore, I decided to pick up that as some basics for today, and to go into those details of class trading strategies. Okay, let's go quickly through those questions, but as mentioned, they are of general relevance, and therefore I switch to a complete document with all those questions and some answers already given to those. You can read if you want, but I will tell you exactly what's going on here with those kind of questions. There was one question related to MT4 as an optimization tool. Of course, if you have an expert advisor for your strategy within your MT4 account, then you can do optimization and backtesting already directly with MT4, which is on the one hand very good because it tells you additionally whether the expert advisor is doing the right job, because you have some basic idea of your strategy and you can backtest the expert advisor and see the trades which have been entered, closed, and so on. So it's a test of the expert advisor as well. But the one who raised the question realized, hey, if I look to those testing results and look to my live trading results, there is some difference. And yeah, as always, there are two reasons in general for those kind of differences. One is slippage. Slippage, of course, we don't have in those backtesting results. Slippage we only have within our real money accounts, and even if you do trading on a demo account, you will realize, that depends a little bit on the broker, but that you even don't have any differences between your set stop loss and take profit and the final result of the trade. So even if there are gaps, then sometimes you will see that the trade is closed at the stop loss as being set. So, but the main reason for those kind of differences between testing and optimization in your real money account is a spread. Normally, when you go to the MT4 backtesting, unfortunately, I have not prepared an example, but maybe I can do it for next week. Then you see when you open the backtesting dialog, then there's something which is called spread, and there's and you can adjust the spread. Normally, the spread is set to current. In most cases, the current spread is low. If you don't do the job at around midnight, then you have a quite low spread value. And this spread is then taken for all the backtesting activities. So my advice is to enter here a fixed number for the spread and look to the history, do some analysis of your specific broker account, do some analysis as we have done in the previous webinar. I think it was one of the first one, and that you get numbers which are more relevant. So it's more bad. Because you need definitely higher numbers for spread, and then you will see that maybe your final results between backtesting and your real money account, they come much closer. The reason behind is, of course, even if you have 95% very low values for spread, that's fine. But just in case you are close to your stop loss level, for example, and then something happens with the spread, you are kicked out of that trade by that spread widening, and the trade is closed at stop loss or even worse. If the spread is fixed to a low value, then that kind of trade would survive, let's say, and maybe finally the trade goes into the take profit, or however your strategy is being set up. So therefore the influence, the impact of spread to be taken into account in backtesting is very, very huge. Okay, so one advice, take simple higher fixed numbers for those spreads. There was another question, how does MT4 compare to other automated trading platforms? Honestly, I don't have that much experience to some other trading platforms. There are only a few, and in principle my minor experience is simply there's no big difference. The bigger difference stems simply from the choice of the broker, because finally all our trades have to be executed either by a market maker by himself, or by STP ECN brokers by forwarding the trades to the liquidity pool. So the more impact on your trading results is the broker of choice. And I have clear preference, and that is go to STP ECN brokers. Maybe I should make a lesson about those kind of abbreviations and kind of brokers, but shortly, that kind of broker, they don't have a real interest in your trades. They simply forward those trades to a so-called liquidity pool. That pool is created by about 15 or 18 big players like Deutsche Bank, UBS, Morgan Stanley, and so on and so on. And there, at that liquidity pool, the trade is finally managed and executed. And your trade goes only to that liquidity pool after something like take profit or stop loss has been reached. So those kind of people or institutes, they don't know your stop loss level. They get your order only after the stop loss or take profit has been reached, or if you just simply make a market order, then that order is forwarded to the liquidity pool as well. So there's no conflict for those kind of brokers, STP, ECN brokers, with your own trades, because they simply don't care about your trade. They earn their money only by commission, and that's all, and not by trading results. Another question was that that there are robots that significantly outperform the average good robots that we can build or find on the web. Is there a specific design of those robots which may outperform all the others, or should we better diversify simply our robots or strategies? So to have a very good overview about robots at all is quite difficult, because most of those accounts you find at Zulu Trade or Ayondo or wherever, most of them have a very short lifetime, and some are only running in demo accounts. So to get a long-term history and a long-term comparison is quite difficult. I simply follow my own rule for money management, and the other I definitely follow is to have a bundle of strategies, so in the order of 10, in order to diversify my my accounts. Is there a specific metric to identify outstanding robots? Yeah, I think there is one. In principle, some websites, they simply publish Sharpe ratios, which I don't think is a good number, because Sharpe ratios, there is no common definition, and at least there is some degree of freedom how to calculate, and that is always taken into the positive whoever is publishing those results. For me, it's something like risk-reward ratio. So it's something, how much money in average is earned per year compared to the drawdown. If you think in both numbers in percentage, then the average profit should outperform or should be higher than the drawdown in percentage of that account. My experience is, of course, there might be strategies which have a drawdown of maybe 30% or even 60%. That's okay if everything is right, but then the profit of those kind of strategies should be in the same order of magnitude. So, and what I always look for is to have a history which is longer than 5 years. That is indeed hard to achieve or hard to compare, because there are not so many outstanding robots with that kind of history, as far as I know. So backtesting or the real lifetime account should definitely be longer than 5 years for those robots. Is optimization the most important part of finding an outstanding strategy? No. I don't believe that optimization itself is something which makes the strategy good. But if you develop your own strategy and you do that step of optimization, then you get what I always call a feeling of that strategy. A feeling means what kind of parameters have more impact on the results than the other? Are there crucial parameters to over-optimize your results? As always, my example with the EMA 200 and EMA 201. If you have a good strategy with 200 and a bad strategy with 201, then definitely I would not go for the strategy even with the EMA of 200. So the process of optimization of a strategy is exactly something which gives you a real insight to your results. With insight, I don't just want to mention the numbers like profit factors or something like that. No, it's really the impact of parameters to the overall result. And if that is being done quite robust, then you have a good and outstanding strategy. I cannot formally prove that. So it's more my, so to say, educated guess, but I think I'm right. Should we focus on building a very well-performing robot or on a well-balanced portfolio of robots? And the very easy and straightforward answer is a yes to the latter. That means we need a balanced portfolio of robots or strategies across different kind of underlyings, different kind of strategies, trend following, trend reversal, breakout, whatever you name it. You need that kind of portfolio, and ideally, even the market is in the, so to say, wrong phase. So a trend following system is stuck into a side market, then ideally that kind of strategy will not earn money, but it will even not lose money. And other kind of strategies would earn money in that kind of market phase. Therefore, definitely you need that kind of portfolio and the portfolio also of underlyings. So in total, we have 4 different kind of underlyings, commodities, stocks or indices, currencies, and everything which is related to interest rates, like, for example, in Germany, the so-called Bund future, or in US T-notes, T-bonds, those kind of underlyings which are related to interest rates. So that means we need that portfolio of strategies, and portfolio of underlyings. You see, there have been a lot of questions, but I think they're good questions, therefore I mention all of them. Money management, does it increase or decrease? What kind of effect will it have to change your risk per trading and so on? We have discussed already martingale strategies, and you got a clear no from my end. So I have a slide to that later, exactly only with 2 strategies. The last question, I think it's the last, or maybe one before. What about completely different techniques or algorithms like time series analysis, Bayesian statistics, machine learning, big data mining, and so on and so on. Can those, by the way, first answer, a very interesting topic, because I think personally the future of trading is directly linked to those kind of things which are named here already, like machine learning and so on, because they are, computer have always an advance, an edge against humans, and not always, but in most cases. Therefore, I think the clear answer is the future lies exactly there, even for trading. But is now MT4 suited for those kind of strategies? That's quite difficult, because really to implement a strategy finally, that I think is possible with MT4. But to develop such a strategy, no, because it's simply too slow, and therefore I would always prefer other techniques like C programming, or like doing everything in Python, or in the language R. Those kind of tools, they will give you insight into those kind of strategies. But if you have set up something like that, then you can do a combination of MT4 and other tools. So, for example, if you have a machine learning algorithm like a so-called decision tree, and that kind of decision tree is updated once in a while, then the output of that decision tree, that can be used by MT4 like an input file with all those kind of decision matrices, and that can be implemented in MT4. But to set up, for example, that kind of decision tree, I think MT4 is not suited. But the combination will help you for that as well. Are there specific techniques really performing better than usual strategies, like pattern recognition, technical analysis? So the one who raised those questions mentioned that quantitative strategies, which is another name for robots, not in general, but they are not achieving exceptional results. Let me first rephrase this question. Who is getting exceptional results? Of course, you will always find some which have currently exceptional results. But for long term, let's see. So once again, I can only think there is no straight answer to that questions. I think what we need is that we need all those kind of strategies. I'm not in favor of the classical technical analysis, but doing something like the next name, pattern recognition, and do it right, not just reading a textbook about candlestick formations and trade after those formations. That works, not trading just the candlestick formations from the book, but doing the job really to identify good patterns and then trade those and do that dynamically. That is a kind of strategy which definitely works. Are those kind of strategies better than others? I don't know. And I cannot prove either the one nor the other. So it's really difficult to give here a quite really good answer. Are there specific strategies like technical indicators, scalping, trend range trading, correlations, trading on news, trading during certain hours? is there something I can name which is directly better? No. I think every kind of strategy mentioned here has its own relevance. And beside scalping, which I personally would not do, because I think for our kind of accounts with the cost structure behind everything which runs only minutes or even below cannot be profitable on a long run. That needs a different cost structure behind. So that means those kind of strategies work, yes, but well, can work, but not for, let's say, normal people who do normal trading. There you need definitely a totally different infrastructure and access to the markets. But nevertheless, we can use all those kind of inputs and building up different kind of strategies, and then setting up our own diversified portfolio. So you see, it took me 25 minutes now to go through all those questions, but I think it was worth doing so. And to the one who has raised all those kind of questions, I have to say thank you, because they helped me to give hopefully good answers and ideas to everybody. So don't stop asking me 10 questions in one row. You can ask me 20 questions if you want. I will try to go through all of those, and I hope that others find those questions interesting as well. There was one questions directly related to money management. And for money management, I have simply a very short answer. Personally, I only have two strategies for risk and money management. Maybe I have to mention there is something additional, that is then creating that portfolio and how to balance the different strategies against each other, and how to say, I give that strategy that amount of money and the other strategy that amount of money, and so on and so on. That is an additional topic. Let's call it portfolio management at all. But for a single trading strategy, I have only two kind of rules. And even those two kind of rules are very close related to each other. So one is simply to say fixed risk. That means I have a strategy. Initially, I have calculated, and let's show you later how I calculate a number like that, and said, hey, 25 euros per trade, that is my risk. And then nothing will change. So no changes at all. Whatever comes, I stick to exactly those numbers. The other strategy is simply to say, I have a fixed percentage of my account equity, and that is the amount of risk per trade I will put into a single trade. This rule is sometimes known as something like a 1% rule. 1% of your account you can put into one single trade. Some people say 0.5, some go up to 2%, whatever. So there's a range. But I don't have, I have a range, but not by guess. Only my range simply comes from the specific strategy. And that I will want to explain just with one example. If, for example, I want to trade in an account of exactly 3,000 euros, let's say that is the current account equity, and that we know. Then, of course, since we only trading known strategies with known history, we know for that kind of strategy the drawdown of that strategy. You know that I always calculate my strategies in the unit R, which is the universal risk number, which is just set to 1. So whenever I enter a trade in trading in strategy development, if that trade goes into the stop loss, into the initial stop loss, I have to say I might even change the stop loss, but always only into the direction of the trade. Then I know for that strategy exactly the number of maximum drawdown. And in my example now, it's simply a number, and that is 30R. There's one remark I have to make. Finally, you have to adjust. I have to adjust the history, because it's not the same to have a strategy with an maximum drawdown of 30R if the history is only 1 year, and compare that strategy with a history of another strategy with 10 years history. That is not the same, but we can balance that as well. And now you have to ask yourself, how much should that account be allowed to go to the south? And in this case, I put that number to 20%. To know, or to say a little bit more about that number, bigger companies or funds, they typically have in mind something between 10 and 20% maximum as being the allowed drawdown. It depends a little bit how conservative you are. There are other, especially private traders, who set up those numbers even to 100% or some to 50%. But now let's simply take as an example that 20% should be the allowed drawdown. And then all the rest to calculate is simple math. So the 20% of the 3,000 euro account would equal to 600 euros. And now I know my 30R, my maximum loss of 30R being the maximum drawdown should equal 600 euros. And yeah, now I know what number I have to risk per trade, or having that kind of risk per trade, and that is then exactly 20 euros. So 600 divided by 30R. So that is the kind I do always my math behind risk management, and doing that setup here, like those numbers, 3,000, 30R, 20% allowed drawdown. That is the initial value, and now it depends. Either I go for A or B, and if I go for A, then nothing will change. And if I go for B, then I will adjust exactly to the current account equity. If it goes up, let's say by 10%, then my risk per trade would increase by 10% as well. If the account goes down by 10%, then the risk per trade would go down by 10% as well. It depends now from how you trade, whether you can do it, let's say in time for every next trade, or if you do that adjustment just, let's say, once a month or once a quarter or once a year. That depends a little bit on the technique, how you trade. But in principle, you could do it just in time and adjust always to the current account equity. So that is my basic rule for risk money management, quite simple, and yeah, that's all. Good. Let's move to complete other topic, some more basic insights into the class trading strategies. I have mentioned those strategies, I think, a couple of weeks ago, and I have done it only very briefly. Of course, it's interesting to have those kind of strategies, and just that you see that I'm not only talking, that I'm already trading that strategy. No, that is another one. This one here is an M5 class trading strategy. It's running quite short and it goes upwards, at least at the moment. So first test results are good, but there is something else. If you, by the way, if you want to have, if you want to look inside to that strategy, you can simply go directly to that link shown in my browser right now, and then you can have always a closer look to that strategy. You might remember that we set up an FX Blue link together, by the way, I think it was last week, and simply by entering exactly fxblue.com users tsctrader _M5, that leads you directly to the account and you can do your own analysis. But let's go back to the overall concept of class trading. Originally, I can only make one remark, and I just make a statement. And my statement is markets have different faces. Okay, I assume everybody would say, yes, I believe markets have different faces. Nevertheless, this is a hypothesis and nothing more. But our feeling, our looking, when we investigate charts, then of course you have the feeling, hey, yeah, markets have different faces. For example, DAX is in a side range since I think now 2 years. There are other markets like, remember a couple of months ago, oil has been simply trending to the south, so that we could call a phase of the market. If you believe in that markets have different phases, then we have directly a simple consequence. And the consequence is that different phases might need different trading setups. Sounds logic, but still there's a question mark behind. So that is something we have to prove. And of course, there's still a challenge, or two challenges. One is to identify the different phases, and finally, if we are able to identify the different phases, then we have to find the appropriate setup for those different phases. Let's do it just a little bit more practical. And let's start with a DAX chart, simply for the last 4 or 5 years. You can't see anymore the candles, but if I would zoom in, then the candles come back again, but I don't care about the candles itself. And of course, we have already in that kind of chart the different phases, or we get a feeling of those phases. Of course, it's always easy to identify those phases in the history. So we would say, wow, here in that range, 2012, 2013, there was a very good trending phase, and yeah, a long only would have been quite nice. Something like that we can observe directly out of the chart. Now the question is, can we find some, let's call them indicators for those phases? And I just want to make it quite easy. Right now, I only will use two indicators. One is a moving average. Let's take 200, for example. Then we have a moving average within our chart. And let's take another indicator, the ATR. Where's ATR? Sorry. There it is. ATR. And let's go for, I don't know, 24. And you see already we need some numbers for that. Or let's now, since the chart is a little bit longer, let's put a higher number, like 1/4 year. And now we have two indicators within our chart. And of course, we have this ATR indicating the volatility of the market. And we have a second indicator, the moving average, exponential moving average, in this case 200, showing us something trending, whether at least if we have higher values in the slope, of course we could call it a trendy market. And we might see, wow, the volatility goes up, especially if market goes down. That is quite similar to the statement if you, for the DAX, you might compare it to the so-called VDAX, which is a volatility or fear measurement tool, or just simply another indicator. You more or less the same kind of story. So even here, one might get to a first conclusion that if the volatility is low, it might be good to enter long trades, just as a first conclusion. And now you see already that I try to find classes, trading or phases, and I want to name that phase low volatility or low ATR values, and then maybe it's a good idea to have a bias for long trades, to look for long trades. At least for that long phase here, my statement is true. And maybe the other statement, if volatility goes up, either I should look for short trades, or maybe the best conclusion is I should do nothing. So not trading at all. So you see already with those two kind of indicators that I can try to separate different market conditions. And that is exactly what is meant by class trading. So find indicators which separate your market or your price movement, your chart, into different segments. And at least within that long range, we would identify a low ATR phase. And that is exactly what I mean with classes, identifying classes for trading. Let's do it a little bit more mathematically. So therefore, let's go back to Excel and my start in order to investigate something like that is simply a chart as we have done already with all our tools during the last couple of weeks or webinars. So we have the prices, open, high, low, close. In this case, we have been downloading those numbers from Yahoo. Then you know that we can calculate the true range and finally the ATR. In this case, I use the ATR 120. By the way, I use higher numbers than in previous webinars, simply otherwise, at least for educating, for showing the results, it would be too noisy, at least if I don't zoom into those charts. Then, of course, we can calculate an EMA. We know the formula, and in this case, I took an EMA value of 200. And what I have done next is I simply build up the slope of the EMA. But let's I go a little bit downwards, then I show you the cell content or the formula behind. You see that I don't use two numbers directly close to each other. So the EMA value of today and the EMA value of last day. No, instead of last day, I took the value 10 days ago. Here the reason is only, once again, for showing the results. If I go for directly the value of the previous candle, then the data would be a little bit too noisy. But the statements, by the way, would still be the same. And now we can have a look to the chart, and let me explain what you can see here. Of course, in the blue line is simply the close value of the DAX. So what we see is 20 years DAX behavior. The red line is the EMA. The yellow line, and now you have to look for the right-hand y-axis, is the ATR value. That is the yellow line, and you have to look that in the middle here is the 0. So of course ATR is always positive, and you see those peaks in the ATR value. And finally, I have the slope in the same graph, and I have simply adjusted by a multiplier for the slope of the EMA, the values to a range which are similar to the ATR values, only then because I have all the numbers in one chart. Now I think it needs a while, but of course we can see or we can draw already first conclusions. So once again, we have, for example, here in the middle of the chart, we have extremely high values of the ATR, and we have, and that is indicated by the slope of the EMA that goes to the south. And that happens several times within our graph. So the ATR, or the value of the ATR, seems to correlate, or better to say, to anti-correlate with the slope of the EMA. That is already a first class for a trading setup. And so looking for high values of ATR might be a good idea to go short into the market. Maybe not directly, but at least we could bias ourselves or we could bias our trades exactly into that kind of direction. But the question is, can we do more just by looking to that kind of graph? And the clear answer is yes. But first, we have to build up our classes for those different market phases. And since we have only 10 minutes left, I show you directly the final result. which is still not a ready for trade setup or a strategy, but I simply want to show how I have done my work here. And up to here, everything is known already from the sheet. What I did additionally, I looked for the typical values within ATR 120 and the slope of my EMA. So what I have done is I simply put all those numbers and copied those numbers into a new sheet and then ordered those numbers by sorting them just by number. And in this case, it's those ATR values sorted by their occurrence, and the graph is showing you, we have low values, we have high values, and we have a lot of values in between. And what I now try to simply calculate, it's quite easy when you have that sorted list, I want to find two limits, simply two numbers, which helps me to have finally three ranges. Let's call it a low range ATR value, a mid-range ATR value, and high values for ATR. And to find those limits is now quite easy, especially if I want to have them equally distributed. Since I have 6,500 data points here, or history, I know exactly that 6,500 divided by 3, that cell number within that Excel sheet has a value which is a good limit for the lower one, and then divided by 3 multiplied by 2 is 4,333, and exactly at that number I will find the next limit. So then I know that 1/3 of all the numbers are below 0.012. I know that 1/3 of all those numbers is higher than 0.019, and 1/3 of all those numbers are exactly in between. So I find simply by math here those limits, those ranges, which divide my ATR values in 3 sections or 3 phases. The same I have done for the slope. For the slope of the EMA, once again, copied all numbers here, and then just a graph to show what numbers we have, and I can get those limits. Once again, quite easy, same rules, and I find a 0.002 being the lower limit and 0.013 being the upper limit. And once again, I know if I apply those rules, those limits, I have equal numbers within one class. That's all. And doing that, I can now create class numbers. And I did it not the same, but from the logic here, it is the same. Not the same for the classes for ATR and the classes for the slope. For the classes ATR, I simply compare the current value. First, if it's higher than the higher limit, then I appoint number 2, or I assign the number 2 for that class. For low values, I assign a 0, and for mid-range values, so values of ATR between those two limits, I assign simply a 1. For the slope classes, I did it a little bit different, but only just opposite. So low values now get a 0, high values get a 2, and mid-range values get a 1. The reason is simply because then the next graph become a little bit more spelling, but the conclusions are always the same. It doesn't matter how you do it, but at least you identify different classes. So now we can create a single class number. A single class number simply, we know that we have values 0, 1, 2 for the ATR class, and we have the numbers 0, 1, 2 for the slope classes. And to get a single class number is just straightforward. Takes the class number ATR plus the class number of the slope multiplied by 3. And then you have a unique class ID, identification number. The values are between 0 and 8, which finally means we have 9 different classes. Now let's have a look to what we can see already within that graph. I know it's a little bit tricky and needs some time to come to first conclusions, but anyhow, finally we will draw all our conclusions within the next webinar mathematically and not just by our eye. So what do we have within that graph? We have the blue line is once again the DAX close values for the last 20 years. And on the right-hand y-axis, we have the class numbers. So, for example, yellow is the class number for ATR, red is the class number for the slope, and the finally computed class identification number is in green. And once again, you see clearly here already within that range, 2000, 2003, we have more or less the complete period. We have the class identification number 8, the highest possible. By the way, that's the reason why I reverse ordered the numbers for EMR slope. And what we see, we have always class number 8, and the market is going south, 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 south. So it seems already that the class ID number already is something which should indicate us what kind of trade we might enter. But that is an investigation we will do independently from that. Although it seems that we know at least for one class an answer already now, and the one answer would be go short whenever the numbers indicate you that you have class number 8, or just by wording, it would mean we have high volatility, so high numbers in ATR, the slope of the EMA 200, which is negative. And that would say, I go short. You know that is not my style of trading, because I want to have at least a stop loss value. So we have to dig into that kind of approach a little bit deeper. But maybe we find additional things just for the opposite. So, for example, maybe exactly the opposite, class number 0, which would mean we have a low value of ATR and we have a high value of slope, of the EMA 200 might indicate us we should enter a long trade. But let's see how we can figure out those things, and that we have finally not only a matrix like I only do it briefly just here, that we have 9 values depending on the class number, and not only just writing down going long, going short, or maybe do nothing. Maybe we can, for each value, for each 9 different classes, we can find a complete independent trading setup, and not only to say I go long, I go short, I do nothing. So that is the logic behind class trading, identifying different phases by different class indicators, building up a final class number, which is only pure math, and then investigating the independent phases for independent trading setups. But everything up to now, and it will be, is done pure mathematically, and not by instinct, not by feeling, or just waking up in the morning. It looks like a long market, and that is exactly what we want to do. Well, already 1 hour, but that's okay. And we will go further with our different classes and setting up the independent trading strategies next week in the next webinar. So for now, if you have any questions, just send me an email at friedrichowski@argus.com. No question that will not be answered. Of course, I like it, and if you share all your ideas, your question with me, that is wonderful, because that will bring us forward, everybody, and that is exactly what I want to achieve with that webinar, and that is what ArgusFX want to achieve as well. So for now, thank you for your attention, and hopefully we see each other next week once again. Okay, bye-bye. Have a good day and a good weekend.